What is risk? For a bank, where does risk come from? And then what should a bank do about it? How do banks manage risk? In this session, I'm going to provide a very brief overview of risk. In future sessions, we will unpack the various sources of bank risks and discuss common approaches to risk management. How do we define risk? Well, when we make financial decisions, there is usually some uncertainty about an outcome that will arrive in the future. I make an investment today, and I'm not sure how much it will pay off tomorrow. Although we don't know what is going to happen, we can usually describe this uncertainty. We can make a list of potential outcomes. Some of these outcomes might be great, others might be undesirable. For example, a bank might be worried about making losses in its loan portfolio. We can also try to assign probabilities to these various potential outcomes. Some events might have a 0 probability. This means they will never happen. Estimating the probability or frequency of an event is not an easy task, but this is central to risk measurement. Banks engage in a variety of activities. Some of these activities expose them to potential losses. These losses may arrive in the future. There is uncertainty surrounding these potential losses. Very small losses might be unlikely. Other losses might have a higher probability. Measuring and managing these potential losses is central to a bank's performance. Let's introduce the main risks facing managers at modern banks. In future sessions, we will look at the measurement and management of these risks in much greater detail. Okay, here we go. Banks invest in assets such as loans and securities. Some of these assets might not repay in full. This is called credit risk. Banks raise short-term funding and invest in long-dated assets. This maturity mismatch across the balance sheet creates something called interest rate risk. Depositors and other liability holders can sometimes quickly withdraw their cash from banks. Banks have to meet these withdrawals, but most of their funds are tied up in hard-to-sell, long-term investments. This presents banks with liquidity risk. Banks hire traders. These traders buy and sell securities and derivatives in financial markets. These instruments are recorded in the trading book. When market conditions change, these positions can gain or lose value. This is called market risk. Finally, we have operational risk. This covers a broad range of risks that can be hard to itemize. It includes the risk that technology or support systems could become inadequate. This could be the result of a cyber attack. It could also come from fintech firms disrupting traditional business models and stealing bank customers and bank revenue. Employee fraud is a major component of operational risk. If one or more of these risks create large enough losses, then our bank could fail. This is sometimes called insolvency risk. Insolvency occurs once the bank's equity is wiped out and liability holders stand to incur losses. Here, if losses are so large that they exceed XD, then the bank fails. In this case, there is a 0.1% chance of that happening. Managers and owners don't want that to happen, so what can they do? Well, they engage in a broad set of tasks called risk control or risk management. There are really 2 steps in this process. First, risk exposures need to be measured. Second, we might want to manage these risk exposures. Here is an illustration of how our bank's profits might vary with interest rates. That's the R on the x-axis. If rates increase, then our bank becomes less profitable. Risk management is a process that breaks this relation. Here, the profits of our bank no longer vary with interest rates. How is this achieved? Well, broadly speaking, banks can do a few things. They should always try and measure and price the risks that they take on board. Loans to unreliable customers should be more expensive. And if the risk is too great, they might prefer not to grant the loan, or they could originate and sell the loan. Either way, the balance sheet exposure would be directly reduced. Banks can also hedge risks, which involves shifting the risk to other financial institutions. Loan guarantees, interest rate derivatives. These are types of financial instruments that allow banks to meet their customer demands, say by granting risky long-term loans, but also limit the risk that the bank will fail. Remember, the goal is to break the link between profits and sources of risk. Let's sum up. We have introduced the concept of risk in a very general sense. We then gave an overview of the specific risks at banks: credit, interest rate, liquidity, market, and operational risk. We then gave an overview of approaches to risk control. At a minimum, banks should measure and price risks. Beyond that, banks can limit risk exposures by altering the balance sheet directly or hedging.